Good afternoon and welcome to our first Switzer webinar for 2015. The tone you're listening to at the moment is mine. I'm Paul Rickard and I'm delighted to welcome to our webinar Peter Switzer. Peter, how are you?
It's nice to be here, Paul. Thanks for welcoming me.
Happy New Year.
Yeah, same to you.
Okay, and before we come back to just a few things to sort of look at how the market's gone, let me just go through a couple of housekeeping matters while a few more people are joining us. Firstly, just the obligatory disclaimer, just to be very clear that of course we don't know anything about your particular circumstances, objectives or financial needs or situations. So the advice that information we're going to talk about today of course is general in nature. And before acting upon anything we say, you should of course consider the appropriateness of the information in regard to your own personal situation, needs and objectives, and if appropriate, seek professional advice. So we always start with that disclaimer. Sorry, we have to say that up front because of course we don't get all the information from you. So it is general, and of course what we say to you may not be right in some cases, or of course may not be right for other people listening to it. And then a couple of housekeeping matters. So firstly, just to make the broadcast a little easier for yourself, please close all the applications and programs that are not in use on your laptop or screen, however you're accessing us today. Please ensure the volume on your computer or speakers is turned up to a comfortable level. And then of course you can send in questions during the webinar via the questions box. Now the arrow points to it. It should be, I think, towards the bottom right hand part of your screen. We'll try to get to as many questions as we can, and my assistant Bernadette will see if we can unmute you if you have a microphone so you can ask the question directly. If you can't, we'll ask that on your behalf. And of course we have a number of questions that were sent in ahead of the webinar and we'll get to those first. So on that note, Peter, let's look at sort of two things. I want to get to what you think's happening and what you think might happen in 2015 and what you think some of the investment themes are as we sort of open up the year. We're sort of about where we started, so we're sort of even with today's move. But let's just look at what happened in 2014. Always good, I think, always look at what's gone on in the past as a way to whether that tells us anything about the future.
Yeah.
On the screen in front of you, you can see the sector weights of the 11 sectors that make up the S&P ASX 200, and you can see their returns across 2014 calendar. So whereas the market only put up on 1.1%, pretty ordinary, when dividends are added back in through what we call the accumulation index, that took it to 5.61%. And I think what's interesting to note, at least a take out of me for 2014, were a couple of things. First of all, the yield sectors by and large did pretty well. They led the market up. So things like property trusts were the star, 27%, utility 16%, telecommunications, which although it's got a few other companies in it, is still by and large Telstra. And financials, which of course is your major banks and AMP, up a very healthy 10%. So as we keep saying, those if we've listened to people out there get out of your bank shares, they didn't get that right.
We didn't say that.
They didn't get that right in 2014. Energy and materials were the laggards, both negative returns.
Particularly materials, Paul, when it's a 15% weight, isn't it, to drop 11.63%. That hurt the index, didn't it?
That hurt the index. And the other star was with healthcare, 24.38%. And that was probably the standout. And again, we've been talking about overweight positions in healthcare. So my take, Peter, on last year was the big picture themes in terms of lower interest rates, weaker Aussie dollar, continued attraction for yield-based stocks were pretty well correct, and that was borne out. Healthcare, again, just because of the demographics of people recognising what was going on there. But overall, we got hit by the oil price and commodity prices, and that's sort of why the index basically finished where it started. What's your sort of feeling?
Yeah, the materials didn't help. The fall in the iron ore price was a negative. It was a drag on our index all year. And remember, we got close to 5,678 at one stage in September. and that means we're only 5% off 6,000 then. So the market was doing okay, but then along came OPEC, and OPEC just said, no, we're not going to cut supply, which everyone thought they would, and the market really just sort of panicked on that. We also had the fact that the Aussie dollar came off the boil, which we predicted. And the interesting thing is, and I've been making this argument in some of the pieces I've written already, is that the things that probably caused some of our biggest problems in 2014, like the falling dollar, which pushed a lot of foreign investors out of our market, that's going to be the reason why I think 2015 is going to be better, because we're going to have a low interest rate environment, we're going to have a low dollar, and a lot of companies will start upgrading their forecasts because of, and let me throw in also, the lower petrol price will also factor in to upgrades for a lot of small cap companies. So I think the stuff that annoyed us on the index this year will probably be the makings of a good index result next year or this year.
So let me see if I can nail that down in two parts. The first part, let's just deal with the key economic or key macro themes at play, and then we'll deal about what that means for the market. So what are your key macro themes for next year?
Key macro themes. Interest rates stay low.
Interest rates stay low.
I don't think they'll cut, because I think the economy is going to be doing a lot better than some of the negative people out there.
But pretty unlikely there's going to be an increase in Australia.
I can't see it. Look,
that's your view?
Yeah. The only way we'll get an interest rate rise will be at the end of the year, because the economy is actually doing so well. And I don't think it's going to happen. Reserve Bank will want to keep interest rates on hold. Some people think there'll be a cut. I don't think so, because the lower petrol price is like an interest rate cut anyway. And I think that lower petrol price will factor in macroeconomically a much better economy, and lots of companies will do well.
Very specific here. So interest rates stay low. That's number one. Number two?
Dollar down to about 75.
Dollar lower.
Sometime, end result, that will push up economic growth.
Okay.
Lower dollar, lower costs. This is one of the greatest cost benefits in our lifetime. And I hated the oil price falling the way it did, but there will be a long-term benefit which the stock market has not enjoyed yet. But come 2015, there'll be lots of companies that will upgrade their earnings outlook, and what happens when they upgrade their earnings outlook? Share prices follow. So that, I think, is going to be the big theme. And of course, no inflation worries. This is going to bring costs down. No inflation worries, that means no interest rate worries. We're going to be laughing our way all the way to the bank by the time we get to December.
Okay, so we've got lower interest rates, lower dollar,
lower costs.
The impact of lower oil prices meaning lower costs for consumers, right?
More income for consumers and lower costs for businesses.
Yep. Anything else? Offshore leads?
Offshore leads. I think Europe will do a little bit better provided Draghi on January 22 is able to introduce some quantitative easing. They need some quantitative easing. And by the way, the economy in Europe won't improve instantaneously. It might take 2 years, but the stock market, like in the US, will move ahead of Europe improving. That's the big question mark.
So, but generally a positive offshore lead, you think?
Yeah. Japan will do better. Abe's in, he won the election, $29 billion worth of stimulation, that will help Japan. And Japan is still our second best export customer, so that makes me happy for the Australian outlook. The housing sector is doing well in Australia. That's going to help offsetting the fact that the mining sector is not going to do so well.
So to quote a phrase we were talking about earlier today, Peter, curveballs from left field, which of course is a bit of a sporting... it's a bit of a mixed metaphor, I think, if you think through that very carefully. Where are the curveballs?
The curveballs will be Europe. If Draghi can't convince the Germans to let him do quantitative easing, mind you, he said this week he doesn't need the Germans. He actually didn't use those words, but he basically said he doesn't need total unanimity was the word he used to introduce quantitative easing. And part of the reason why we saw Europe go up this week was because there's a belief that Draghi will introduce quantitative easing of an American kind that will help the European outlook. So curveball, Greece, some people worry about Greece. Greece could be a problem short term. I love that comment by someone who said that, why worry about Greece? It peaked in 453 BC. Unfair, but still. America's not going to be a problem. Ukraine and Putin, I've got a funny feeling the economic pressure on Putin will be, he'll be looking for some kind of solution to his Ukraine problem. So Yeah.
Do you take this talk about deflation seriously? I mean, should we really be worried about that?
If I thought the deflation was being caused by the global demand just really collapsing, I'd be worried. The deflation is going to come from costs going down. It's like during the OPEC problems of the 70s, it was all cost push inflation because oil prices were going. The flip side must be cost push disinflation first. That's when inflation starts to fall, and you've still got inflation but at low levels. Then it's deflation. I don't worry about that kind of deflation when it's driven by costs.
Okay, so let's sum that up and bring it back to the market, which was the second part of the question. So by and large, the macro themes for Australia are lower interest rates, a lower dollar, the beneficial impact of lower oil prices through increasing consumer
The whole
push.
world gets a benefit from that.
And generally positive leads from the offshore markets, I think, are sort of the four or five themes. A couple of curveballs, but there's always curveballs we can't predict. Looking at the market, I think you're still pretty much talking about a higher market over this year.
I think stocks go up.
Yep. You're still your call.
Oh, stocks are going to go up for sure.
Okay.
Yeah, I've learned giving people numbers can come back to bite me, but certainly I think the fact that we went up 1.1%, throw in dividends 5%, throw in franking, we're still up 7% this year. So it's much better than term deposits. But I do think our time will come because a lot of small caps haven't been able to participate in the improvement in the market. Lower oil costs will help a lot of small businesses.
So looking at the sectors and the parts of the market, where are the bits that you, what you've said? Where are the bits
I think consumer staples will do better this year than last year, that's for sure.
And that's your Woolies and Wesfarmers and Coca-Cola Amatills and a few others,
Consumer discretionary will do better. I worry about consumer discretionary because they're fighting not only the challenge of a lower dollar, but they've also got the online threat as well. So consumer discretionary will do better next year than this year, I'm sure of that, but it's not going to be a great standout story. On energy, I suspect because it's been a hard year for energy, it'll do a little bit better next year. I don't think it'll shoot the lights out. I hope it does. By the way, it would if OPEC turned around and said, we're going to cut supplies, I think the oil price would spike. And that would help a lot of those companies. But OPEC is playing a game a bit like BHP and Rio. BHP and Rio are trying to hurt all the high-cost small producers out there, and that's why they're throwing supply at the market. So it hasn't been just China driving the commodity prices down. BHP and Rio have been driving commodity prices down by pushing more and more supply into the market, and they're trying to hurt smaller producers. Well, OPEC's doing the same thing as well. But if OPEC turned around and said, we will now cut our production, well then that would push the market up. So I think both materials and energy will probably have a better year in 2015 and 14, but I'm not sure whether they're going to shoot the lights out.
Okay. Any other key comments?
Industrial should do well because they're going to benefit from lower costs.
I mean, I find it really hard this year to actually put my money into the sectors. I'm a much more balanced person this year because a little unusual really, but I still think the yield sectors have an edge because lower interest rates stay here, but I don't like energy and materials. I just think that we won't recover quickly from these changes, and I think there's going to be a little bit of some of the local companies will benefit from a lower dollar, so it's a bit of orientation. It's probably my
Paul, I would say in all honesty, picking the companies that winning is not going to be easy, and that I am actually playing the STW ETF on the basis that I think the index was mistreated this year and it should do better next year. That's a pretty simple play.
Okay, that's enough from us to lead this out. Let's go into some questions now. We've got quite a few written questions. I'll get to most of those first. I understand we've got a number of come in the line. We are having a little technical problem with our microphone, so may have to read those questions out, but let me go give priority to the people that put some questions beforehand. So Woolworths and Wesfarmers, Peter, hopefully this question comes from Leon, hopefully you can see that on your screen.
I think Wesfarmers will continue to do okay. It's been quite a stellar performer, hasn't it? So for it to continually keep doing really well is going to be hard for it. I think Woolworths is being mistreated at the moment. I think it's pretty good value at these prices. It's a kind of company, I think it's a good quality company, and so I'm quite happy. I bought some Woolworths at low prices because, as I say, I wasn't holding Woolworths. I've been kicking myself. I missed it $24 some years ago, but when I got the 29s, I thought, yeah, not bad, good company.
Look, I'm going along Woolworths. I recognise that at the moment in two things. One, Wesfarmers through Coles is winning the sales war, but I think the market's been too hard on Woolworths. Now, my other caution, if you read my Switzer Daily article the other day, is don't bet against the shorters. The shorters are in Woolworths at the moment, so there's quite a high short position and growing. So you're going to have to be patient with Woolworths. You can see the way you can trade it yesterday. As soon as they get a chance, they come in and they sell it. And so that's one of the lessons from last year. But I'm orientating towards Woolworths over Wesfarmers. Both companies, I think, did it too tough last year. I think they will benefit, but I think you're going to need to be patient on Woolworths, and so it's no urgency to buy, but it's a nibble stock.
But also remember, Woolworths and Wesfarmers have enormous product ranges, and those products are going to become cheaper because of lower oil costs as well. And they would be big, they have very big transport bills as well, Paul. So I think they're well placed. And by the way, shorters got it wrong with Harvey Norman, big time.
They do, and they sometimes do get it wrong. So I just make that caveat. Got a couple of questions about Santos. Oh, let me deal with another question first of all from John about Medibank. Currently around $2.40, I think, this morning. Look, I have to be honest and say I'm surprised where Medibank has got to. I've been wrong. I didn't really like it. I bought some in the float. I sold mine too early. I just think it's massively overpriced, but the market seems to be out there. So
it kind of conforms to your idea around people like yield plays, Paul, isn't it? And maybe if we get a rash of really good news and the stock market does take off, a lot of people will dump defensive stocks like Medibank Private, and they'll go chasing smaller cap companies that are looking good. But that's still ahead of us. There's no guarantee it's going to happen in the first 6 months.
That's a really good point, and I can see that in my portfolios, which we're just updating, which will be coming in the next couple of weeks. But I've had the same problem finding stocks, and you know, what I didn't show in the earlier data is that 2014 was again like 2013. The small caps performed terribly.
Yep.
And the small caps are down last year, and they're down the last couple of years. And so all the growth in the market's been coming largely in the top 100 stocks. And at the moment, I think you're seeing that because the reason why Medibank is where it is I think people just like to see it as a defensive stock. It's reasonably safe. It's going to pay an okay dividend, not spectacular, not going to go down much, and that's how the fund managers are doing it. They're not selling it. So $2.40, I think is expensive. So I suppose my caution is, would I buy it at this level? Absolutely not.
I wouldn't either.
If I hold it, I've sold mine, I'm out. Doesn't mean it won't go higher. I think if the market goes up 20%, I doubt Medibank goes up 20% would be my caution. It will lag in a bull market.
Yeah. But isn't it interesting? I think a couple of weeks ago I wrote a story where people asked me what I might like to buy this year, and I think I mentioned that I liked Wham. Paul, remember that one? Wham about $1.95.
Yep.
And like today it's $2.06. It's been a nice gain over that period of time. I think, and I'm not trying to say buy my own trumpet here, but what I'm saying is it's often hard to pick the small cap companies that are going to do very well, and that's why I recommend let Jeff Wilson do it, because Wilson actually explores these companies much better than most of us does. But also, even just playing an ETF will pick up a lot of these companies that we don't know are going to do really well going forward, but you get the whole spectrum of those that could benefit from that.
Okay, the second question I'll just deal with quickly about interpreting return on equity, ROE. First of all, it's not always as easy to calculate as it looks, because you actually have to get the underlying capital base of the company and adjust that for things during the year. I think one of the stories is that ultimately, every company should measure their performance by return on equity. In other words, if they've got $1 billion worth of capital, what do they make on that capital, and what does it translate to in percentage terms, so you can evaluate company A versus company B. typically companies that are really doing well talk about their ROE, and companies that are doing badly never talk about it, right? So if you can pick up some of the company presentations, sometimes they'll mention it, and generally underperforming companies don't go near it. So it's not universally interpreted. So look, it's one of the reasons why Commonwealth Bank, banking is a good example, is consistently the most expensive stock, because the return on equity of Commonwealth Bank is around 18-19%, and the return on equity from the other three stock banks is more like about 14-15%, and it's been that way for the best part of a decade.
Yeah.
And that's why it trades at such a high P compared to the other three banks. So,
but can it be misleading, Paul?
Well, look, it's not generally not misleading. Again, you've got to look at it's a question of how you measure earnings. You know, it really should be looking at operating earnings over equity, because again, you get one off. So, look, you've got to be a little bit careful, but probably the best way to do it is to look over the company. You'll see BHP, for example, puts a lot of faith in. They talk about capital return rates on any project. Those companies should be getting up to 15% ROEs, and they're not, because you can get 5% of the bank, can't you, with a bit of adjustment? So why invest in a company? Why pay someone else to do it? So, look, again, that's how I interpret the measure. It's a good sign. As I said, the higher the ROE, generally the better the company.
Okay.
We've got another question. We just keep moving on. We'll come to some of your questions about Santos. Now, we've got lots of questions on the oil companies. So Santos and Oil Search and Woodside and others have been hit by the oil price, which is sort of now about $50. Santos has had a little rally today. It's up 3% to $7.52.
Just a long way from where it was.
It's a long way from where it was. It's not still too far off where it's been. Its bottom is $6.96, but it was at $15.32 in the middle of the year. Yeah. What's your view on these oil stocks, Peter?
Yeah.
I mean, it's a buying time? How do you play it?
Well, the word obvious it's not an obvious buy. It certainly is a buy for someone who is interested in a speculative play. As I mentioned earlier, if OPEC changes its tune, that share price could spike $2 or $3 in a day or two easily. But it's a speculative play. Of all the companies in that space, I like Woodside best because it's a good dividend payer. It's picked up Apache's asset recently. It's got a lot of money, and it is trawling through the higher cost producers who are really copying at the moment. But I hold Santos, and I'm probably thinking about whether I should dollar cost average down at this point in time. I think there's also a number of government decisions that could affect Santos. Yep. It's got a CSG problem. It's even got an Alan Jones problem.
For Sydney listeners, you'll know about the Alan Jones problem.
Yeah.
He's out there, he's not on the radio today, but he beats up every day about coal seam gas.
So these are the issues around Santos. I know when everyone's feeling good about energy, Oil Search always gets a tick. But when anything goes wrong, boy, it gets clobbered. So I think Santos and Oil Search are for speculators in the small part of your portfolio which doesn't relate to your core. If you really want to play this one, I think Woodside's a safer one because of its dividend.
Okay. Look, I'm pretty much in the same camp. I don't think we've seen the end of the energy stock route. Now, that doesn't mean the oil price is going to go lower. The oil price could well have bottomed, but I just don't think the stocks are fully priced it all in. And I think it's unlikely when you get these sort of events that prices of these things recover very quickly. Sure, they'll get oversold and they'll bounce back up, but my guess is when you get this sort of movement, these companies will now immediately go into cost control first. So the first thing they're going to do is be cutting all their costs, all their marginal production, all their marginal exploration. So in that sort of environment, although that sounds good, it usually costs money to cut costs.
Yeah.
I think if they're going to find it hard to produce, the earnings are going to get marked down seriously. It's a bit like the mining services company. We've seen the same thing go in mining services, or the end of the mining boom, and that probably finished 18 months ago, and 18 months later, although the mining service companies had a big dip, they're still lower today than they were 12 months ago and 18 months ago, because these things don't recover quickly. So I'm not necessarily bearish on oil prices. I think oil prices go up. I'm not sure we've seen all the impact of this now flow through into stock. So I'm with you. I'm going to nibble at Woodside, but I'm in no hurry. bear with me while I've got a little technical problem to make sure that this is always, we would have seen this, Peter, but we've just had a little screen flash up.
No, it actually came on mine too. I've never really
Microsoft, I don't know if you can see it out there, but Microsoft the most annoying people sometimes. That wasn't intended. But I wouldn't be rushing out to buy Santos. It doesn't mean it's not a good trade for the next couple of weeks, but as an investor, I'm in no hurry. I think.
I suspect it's not going to go too much lower. It's been really clobbered, but. And Paul, we should just throw in, OPEC is in control of this price of oil, and it could surprise the market. That's the only thing I would say. It could surprise the market. So if you're going to gamble, you're going to gamble on that.
Okay. Got another question here, which is also related to questions just coming from Sherman. So let's do with this first one.
Yeah.
And Peter, you've stated, this is from Greg, and it says you've stated that it's a good idea to only buying the dips on the ASX. Are you talking about dips in blue chip stocks only? So when you talk about buying the dips, what do you mean?
Yeah, I think it always depends on how you're investing. Like, for example, if you're a person who has a portfolio primarily of good dividend payers and there's a substantial dip, that's a no-brainer, absolute no-brainer. If you're holding a whole lot of speculative stocks which haven't been doing well, then that's, mate, if that's your investment strategy, I guess you'd still do it, but you'd have to make sure that each individual company is worth buying on. But I primarily look at two things. There are some of our investors, they do play ETFs. So if the market drops, say, as it did, 9% before Christmas, well, that's a great time to buy. But certainly when we saw the banks drop down, like CBA dropped from 80s down to 75, well, that was a classic dip on that particular company. Why wouldn't you buy it? And I think that's basically my strategy.
Okay, so let's run a couple of questions about ETF. I'm just going to skip forward here because I've got a question from Anthony about the STW ETF.
Yeah.
So for those of you who aren't familiar, the STW is an ETF from State Street through what the company called as SPDR, Spider. And it's an ETF over the S&P ASX 200, and it's probably the benchmark Australian ETF. Now there are others, but that tracks the S&P ASX 200. And his question is, that's one way to invest in the market and talk about what you're talking about buying.
Yeah, particularly when you can't differentiate individual companies if you like. Yeah.
So let me go to the second part of the question, and why not listed and trading under NTA? Well, Anthony, I wrote about this quite extensively, a couple of times in the Switzer Super Report. I would always buy the LIC if it was trading at or around NTA. And the LICs I'm talking about, there are three LICs that really are what I've described as broad-based LICs. Those are from Argo, from Milton Corporation, and the third one is from AFIC.
AFIC.
Okay, so they're LICs all around about $3 or $4 billion. So when I say they're broad-based, they are largely investing in the major companies. They take a little bit of a position, but if you look at their track record over 3, 5, 10 years, they're all ahead of the index over pretty well every time period. Not by a lot, but by a little bit. And so you can buy them directly on the stock market. ARGs and co for Argo.
So you're saying when that matches the NTA, that's when you're happy to buy?
Yeah, if I'd actually pay a little bit of a premium for the LICs, those three, if I was looking at invest in the market as a whole, because they've demonstrated and they track on a performance basis that they can marginally outperform the index. However, they aren't trading at a premium, at a discount. Most of them are trading at a substantial premium at the moment. I haven't checked it the last couple of weeks, but if you go to their websites, they'll actually show you essentially what the premium is, and you can also calculate the premium. So the trouble with LICs is that they are required to report their net tangible asset value. They have to do it by about the 5th working day of the month. For the ones that are very broad-based, such as Argo or AFIC or Milton Corporation, you could be 99% confident that the NTA you calculate simply by taking the end-of-month NTA they're publishing and adjusting it for up or down by wherever the index has moved over those 5 or 10 days whenever you're doing it, and then comparing to them where it's actually trading it, you can work out the premium or discount. For LICs that are trading in small companies, you can't do that because you don't know their positions. But for the major LICs, I would buy them if they were trading at a discount up to a small premium. If they were trading at more than a premium of 3 or 4%, I'd buy the ETF.
Good point. Good point.
So that's my answer to your question, Anthony. If you go to Switzer Super Report, look under an article I wrote on this a couple of months ago. It was quite extensive, and it's not that hard.
It was a brilliant article too.
It was a brilliant article. Thanks for the compliment, Peter. But I've also now want to just move on to ETFs. I've got a couple more questions about ETF. This one from Shervinez. Now, we're having some unmute problems, but I might get my assistant Bernadette just to... Have you got the full question there from Shervinez to set this in?
Shervinaz has asked, please explain how and with whom to invest with for ETF S&P 500 IVV.
Okay, so just I suppose this just for your benefit, Shervinaz, everyone who's asking, all the ETFs are listed on the stock exchange, and their ASX code is IVV. In this case, this is an ETF from iShares, is the issuer, and it tracks the US S&P 500 index. If you want to invest in it, all you do is you go to your broker, type in the code IVV, and press the buy button. And if you'll notice that if you look at a pricing screen, that the better ETFs have good, what I describe as two-way markets. That is that people like iShares appoint brokers to make markets in the stock. It's currently bid at 254.5, set at 254.50 and offered at 254.60. They'll make a market right throughout the day on it, and you'll get a very narrow spread between bid and offer. So
you like IVV, Paul? Well, I'm sure.
I own some IVV. I mean, you're going to buy it at the right time. So obviously it's up a little bit today. It's up 0.56%. That's the US market, but also our dollars bounce back. So of course it's a it's a US market coming back into Australian dollars. But I think it's the way I invest in the US. It's the easiest way.
Yeah, and look, the earlier question about buying the dip. When the US market had that near correction and didn't quite get 10%, that was a perfect time to buy the IVV because you get the bounce back. Plus, there's that currency benefit as well. If the Aussie dollar goes from 81 to 75, that's nearly a 7 or 8% currency gain on that particular trade. So even if Wall Street only goes up 5%, add the currency, you could get 12%.
The other one is the Vanguard one. I'm just trying to think of the code for the Vanguard one, which tracks a slightly broader index. If you go to the Vanguard website, in fact, I'll find that while I'm talking. The other way you can do that. Okay, so that's sort of... Any other questions on ETFs while we're just moving on those? I think that was sort of my ETF question I had.
There's one from Andrew Button. He's asked, please explain the treatment of dividends and franking credits in ETFs, both domestic and international.
Okay, so that's a good question, Andrew. You deal with one of the downsides with an ETF. It's the tax downside. So first of all, the way ETFs work is they will make you pay distributions to you. So a domestic ETF, for example, the STW we're talking about, which is the iShares Australian S&P ASX the Spider S&P ASX 200 ETF, that will generally pay a dividend every quarter, I think it is, and they will pass on the franking credit. So because it's invested in the S&P ASX 200, you could expect that the market dividend at the moment is about 4.5%.
That's where it was.
Franking is about 70% roughly. So if you invest in that ETF, you will get every quarter a dividend. It'll be their actual amount that they get back on the shares they own, but effectively it'll work out at an average yield of about 4.5%, and it'll be franked to around 70%. So you'll get that paid to you. At the end of the year, as I mentioned, the downside is you'll end up with a tax statement, and you'll have to declare it as trust income, and it can be a little messy because there'll be different tax treatment. The same applies with the international things, that they will provide us a quarterly distribution. It'll be treated as foreign income, and again, you'll have to wait till you get your tax statement at the end of the year from the issuer before you can work out what to do with it. So there's a bit of mess, a bit fiddly.
But any ordinary accountant can do it for you.
Any ordinary accountant can do it for you. Should be able to do it for you, despite...
They don't change it to another ordinary accountant.
If they don't change to another ordinary accountant. So that's the status of that. So they're just effectively like a managed fund. They're just distributing what they get through their underlying investments back to you.
Yeah.
Most pay a quarterly distribution. Franking credits get passed on in full. Any other tax benefits get passed on in full, but you'll need your tax statement from the issuer to work that
Here's
out.
a question people might be asking, Paul, as well, is that looking at that, how come, if you added in the dividends for the whole stock market, it was around 5.6%. Why is the ETFs one slightly less?
Oh, well, it'll be around that. Well, no, it'll be
similar.
Dividend, because the 1.1 was capital.
Yeah.
It'll be round about 5.6, 1.1 to 5.6 is about 4.5%. It'll be round about 4.5%.
Okay, fine. All right.
Not the.
That's right. That's
Yep.
right.
So we've got another question there. I'm just going to move on here to one of the earlier questions we had. So we had a question from Peter about Buru Energy, not a company I know a lot about. But Peter, I think the question there from Peter is he bought it at 33.5 cents. It went up to almost, I think, $3.
$3 at one stage.
Did very well at one stage. It's now back to, I think earlier today was about 34 cents.
He's still in the money.
So he was marginally in the money a short time ago. What do you do where you've got a sort of a second tier oil stock at the moment? Do you hang on? Do you what would you be doing?
I would hang on for two reasons. One is, if the oil prices improve, there will be a bit of a bounce. You won't see $3 a share. But also the big companies are buying up the smallies. We're seeing even Kerry Stokes is buying small mining companies at the moment because of the problems we're seeing in materials and also in energy. So I'd be inclined to hang on to it. Because you've copped the worst of it, $3 down to 33 cents or 34 cents. So that'd be my inclination, hang on to it.
Yeah, look, I think it's always a hard call what to know when you've got the great thing is you took some profits, you've covered all your costs anyhow, so, but I guess if you don't, in that situation, you probably hang on and hope for the best a little bit.
Yeah, he has covered his outlays.
Look, maybe at the end of the year, if you've got tax losses and you've got other gains and it's worthwhile crystallising the capital loss, you do so and you would generate a capital loss for tax purposes. Look, there are two schools of thoughts, and the first school of thought is the old trading axiom: your first loss is your best loss.
Yeah.
In other words, if you desire to lose money on something, then dump it, and there's a lot of truth in that.
Yeah.
When you know something position is wrong. I think if I was your school where you've made some money already and it's gone down so far, and the loss is pretty finite. What else you can make? Well, maybe you hang on to it.
But also, Paul, that's a really good cliche. If the management is screwing up and the company's just going downhill, like ABC Learning Centres, when it was going downhill, getting out was probably the best thing to do. But these guys, and I don't know Buru well, but it could be just simply what's happening to Santos, that the oil price has just fallen by so much, bang, it's really copped it. So I'd be looking at that kind of analysis as well. Is the management still good? What is the company saying? Blah, blah, blah. What's this cash flow?
Do they have enough cash that they could just sort of cease exploration and put all of the company in shell if they need to, if oil prices stay consistent? Look, you've got to look at things like that. And I read the chairman's statement from about a week ago, which seemed to create a slightly more robust and rosy outlook. But I don't know.
The chairmans don't exaggerate, Paul.
Chairmans don't exaggerate at all, Peter. So we'll, as you well know. Yeah. Okay, so let's go back to another question we had here, Peter. Look, this is putting us on the spot here. This is a question from one of Charlie's recommendations, GID.
It's a diabetes company, isn't it?
Which is a diabetes company, and it's done pretty terribly the last 6 or 9 months. Should I continue to hold, and what's our view on it? So I'm going to throw that one to you, Peter.
I know nothing about it apart from what Charlie wrote about. It was the sort of company that I would chase, and I've just got no view on this one. But I tell you what we will do is ask Charlie when he gets back from his holidays what is his current position on GID.
Yep, look, I have nothing to add to that.
Right.
I guess I'm probably thinking that Charlie fell in love with the technology without looking at some of the other issues.
The chart looks terrible. I looked at the chart.
The chart looks shocking, and We are. The second question's a bit related, Ray, not to GID, but I think it's interesting that we're talking about WAM and having a lot of cash. This is Jeff Wilson. At our last webinar, we had Jeff Wilson, and Jeff was a little bearish on the outlook for 2015.
Yeah. Was he still holding 45% there?
I didn't know it was quite 45%, but look, that's what a listed investment company, of course, can do, and you get smart managers like Jeff Wilson who don't feel the pressure to go and have to perform.
Yep.
And sometimes Roger Montgomery is the same. They feel the safest option is cash. I mean, I hold cash in my portfolio, but Peter, you sort of at times hold cash, but you're much more sort of a pure equities guy, aren't you?
Yeah. I do change. Well, I think equities. The day I think equities won't go up, I'll start holding more cash. I guess I consider myself a young man, Paul, and that's why I have a high risk profile. But certainly, I think in the case of Jeff is
the young bit. Just define young people.
Young is my age. Anyway, but Jeff is the kind of guy who, when he thinks that the market has run ahead, he then will take profit, hold the cash, and wait for another sell-off. Now, there's been a bit of a sell-off, around Christmas. He may well be a buyer. I wouldn't be surprised if he's holding a little bit less cash now. But my view is, if you're a balanced investor, maybe you should be holding, 40, 35% cash. But I quite personally,
that's cash and fixed income.
Yeah, and term deposits and things like that. Yeah. So I think that, but Jeff is you never know where he's actually playing. He doesn't have to tell you as well, but he's quite honest when he's holding cash. He tells us this.
Okay, we've got another question here from. Before I go to the next question from Andrew, I just wanted to come back. That Vanguard International ETF is code VTS. It's the Vanguard US Total Market Shares ETF. That's another very big one. Management fees of only 0.05%.
Yeah,
it's a huge ETF.
Yeah.
Something like, so that tracks a different index but a broader US index. So they're the two to look at, IVV or VTS, if you're looking for the easy way to invest in the US
His founder, Jack Bogle, was the guy who created the easy way to invest, didn't he?
Okay, we've got a question here from Andrew about Woolworths. Do you want to just, Bernadette, I'll pass that to you.
So Andrew Button has asked, I purchased Woolworths at $36 on Charlie's recommendation. What do you think of the prospects of Woolworths going forward?
Well, I sort of think I covered that, Andrew, but let me just go through what's happened. Woolworths started last year about $33.85. They got to high about $38, $39. And I think Charlie's recommendation sort of came in the middle of that period. The market then started to see, I think they peaked somewhere around about August. The market started to see it as a bit expensive. They then put in a couple of fairly sloppy quarterly sales results. And then there's also some announcements around Masters, which disappointed. So then what's obviously happened in the last month or two is I said a lot of these professionals are out there shorting it. So I keep talking about the number of short sellers. Woolworths was over 4% the other day, which is very high by major company standards. So at the moment you've got a lot of professionals out there. These are professional traders betting that Woolworths is going to continue to do it a little tough because they're losing. Coles is making a bit of inroads. I think their fresh campaign hasn't been particularly successful. Masters is still struggling, and they're going to hold the price down. And we saw at the start of the thing, overall the consumer staples index last year was down. Both Wesfarmers and Woolworths went backwards, and Woolworths felt it more than Wesfarmers. So my guess is that Woolworths is still buying. I'm buying at these levels. I'm
up 1% today. Up 1% today.
But I don't think I'm not looking for an immediate huge turnaround because the shorters.
36 might be a way off, Paul, I think.
So, but I think it's solid dividend. It's almost like an annuity stock. We talked about Medibank. I mean, for the life of me, I can't see the attraction of why Medibank's considered to be an annuity stock when Woolworths is not. Right?
Yeah. To me, I think Woolworths at these sorts of prices is a classic dollar cost average play. That if you bought high and you believe in the company, and you and I do, at these sort of prices you bring your average cost down. So you could probably bring it from 36 down to 32 or so. And I think over the next year, I wouldn't be surprised to see Woolworths back at 32. And
have a look at the Woolworths share price. Woolworths shares, just if you don't recall, were issued at $2.40 back in 1998 or something. They're now $35, $36. They're like Commonwealth Bank. The dividend every half year has gone up.
That's a good point.
You know, they're a great company, dominant in the share. Look, the shorts, they tried it with the banks in Australia a couple of last year. They tried to sell the banks down. These are allegedly offshore players. They won't go away quickly.
Yeah.
That's why I'm saying you don't necessarily expect Woolworths to jump right back up again. But at the moment, I think they're worth buying. I'm not in any hurry. I'm nibbling. I'll buy some more if it goes lower again.
Yeah, me too.
But I'm just cautioning you that I know that you can see that the short professionals are in there. Some of the professionals are selling it. So that's my position on Woolworths. And I'm going to continue to recommend it as a buy. And well, it's a bit like you, Peter, if we get it wrong, we get it wrong.
Well,
so.
but the thing is, if we get it wrong, we're still getting dividends, and it's a company that will come good.
Yep. Okay, so we've done GID. We've got a couple of. This is I think we've done that question from Andy. I'm going to just go to this. Talk about this for a moment. We've sort of covered the second question of this question about Santos, but just talk about the exchange rate and again missing the boat and buying opportunities, Peter. So do you want to just deal with this question?
Well, we better read the question out because I actually haven't seen this one. So, do you still consider buying selected US or exposed stocks one of the best return prospects for Australian? Approximately a exchange rate you consider buying opportunity. Look, I think that the US stock market will go up somewhere between 5 and 10% this year. It could even be more, but let me be conservative and say, let's say 5. This is the strongest economy in the world at the moment, and the data continues to be strong. I don't think the Fed's going to rush to raise interest rates to unnerve this economic improvement in the US, and so therefore I think Wall Street, the S&P 500 will go up at least 5%. Now from an Australian point of view, I think the Aussie dollar is going to go to 75 over the course of this year. Greenback goes up, Aussie goes down. There could be a 7 or 8% benefit there. That's 12%. To get 12% out of one of the best stock markets in the world doesn't look like a high-risk strategy for 1 year. I could change my mind this time next year, could say, well, they did really well, let's be really careful. But for this year, I'm happy to bet on the Americans.
Okay, I've got a question here from Angela. Just coming back to LICs for a moment, and I'm going to throw to a question from John in a moment. But when you're talking about buying LICs when they're trading at a discount to NTA, is this the pre-tax NTA or the post-tax NTA? Look at the pre-tax NTA. So the difference between the two is that within a listed investment company, they have a lot of unrealised capital gains and losses. If a listed investment company was to be wound up today, they'd have to sell all their assets, and that's why they quote an NTA both on a pre-tax basis and on a post-tax basis. The post-tax would be if they wound up the listed investment company, had to sell the assets, they'd take profits, therefore their NTA, the distribution back to unit or shareholders would be lower. Generally the pre-tax NTA is higher, and that assumes that there isn't the tax impact. Generally, they don't sell everything; they hang on. So, and because they offset gains and losses.
So pre-tax is the one they should use on
you
that
should be looking
basis.
about a pre-tax basis.
That's a good question.
But they are required to publish both, and that's why they're there. So,
Okay, that's a good question. Not a bad answer either, Paul.
Look at the basis of the higher number, which will be the pre-tax NTA. And that's why I've said if they're trading at a big premium, I don't go to them. So it's worthwhile looking at that.
Point.
Okay, a question from John about the GST base. Peter, this is one for you.
Yeah.
What might be the effect of a widening of the GST base or an increase on the GST base on the market?
It's a good question. I don't think we're going to see it over the next 2 years, even though I suspect the government needs it. But because the federal government is so unpopular now, the last thing these guys could sell would be either a broader or a higher GST. If they did it, there would be some businesses that would have a there would be a negative implication in the retail area, particularly fresh food and things like that. There could be a slight effect, but it's a really good question. I don't think there's a standout answer. I don't really think it would hurt the market too much. That's my view. Medical companies, because of course it would be put onto health, so maybe some health companies have a slight profit implication, but the taxes that the businesses pay is rebated to them anyway. So
I think one they're talking about is education, and I don't know how there are a lot of private education companies like G8 and others. I think some of those suppliers are taxable and some aren't. I think there's some suggestion around extending GST to that, isn't there? Or?
So education would be one area you have to look at, but the people.
But politically, they're not going to do it,
that's
right?
And the people who buy these services, the people who are putting their kids in preschool care to go to work, it's not going to change.
You're on the on I think Sunrise yesterday talking about the GST on offshore goods, right?
Yeah.
Which is currently $1,000 is exempt.
Yeah.
Below $1,000. You're saying that they'll go ahead and make that change?
Well, that's another one that. So the thing is this. If they do it, they're going to offend a lot of consumers. Economically, as an economist, I say they should definitely do it. It's unfair for local producers to have to compete with foreigners who aren't paying GST on products up to $1,000. However, I just don't think this government can afford to offend all the consumers, because at the moment, the whole world, all Australians, are looking more and more at buying stuff online, and it would be an enormous negative. And I can remember when Jerry Harvey actually said there should be a GST on these products, and people started calling him, an unfair billionaire who was trying to make life hard for everyday consumers. I can't see them doing it.
Okay, all right. Now, I've got a question here from LP. I'm having to work this. And the question I think I can answer pretty quickly. What would be your best specific recommendation for getting broad-based exposure to the US market through the ASX? As I said, I buy the IVV ETF. Code IVV from iShares. It's one I own. It's really easy, good liquidity, and the easiest way to do it. Okay, we've got a question that we didn't cover before from Anthony, I think it is. Just while you're thinking about Lend-Lease and New Farm, Peter, I might just deal with the last two. First of all, Leighton's. I haven't caught up with why Leighton's dropped a little bit this week. I haven't seen how it's going today, but I think one of the things about Leighton's now is you've got to be a little bit careful. It's very thin. It's becoming a thin stock because it's almost 75% owned by ACS, or their subsidiary Hockteeth. So they're in control of that company. They'll do what they want with it, and the market in some ways is a little bit irrelevant. I personally think the market got a little bit excited with Leighton's as they realised that Spanish weren't going away. There's a lot of very negative press. Fairfax Press got that horribly wrong again, as usual. It's been one of our portfolios, one of our best performers last year. We're exiting it at the end of this year, moving out of our portfolio for 2015. It's had its run, I think, a little bit, and still quite a bit of exposure to mining services. So it's now getting probably a little bit too thin. I can't tell you what's happened there this week because I couldn't see any news. Question part of that too: do you think the banks will remain strong? Again, I think they will. Interest rates stay low, banks stay popular. Interest rates go up. Different story. Look, if the economy gets stronger, Paul, people have to do work with the banks. The banks are the middlemen in so many economic transactions. So if I'm saying, and I am, that the economy it might be slow the first part of this year, but I think it picks up. Low interest rates, the low price of petrol is going to help the economy. And when people get confident, you know where they go to? The bank. And they borrow money and they buy stuff. So I'm happy with the banks this year. Okay, and again, look, I'd add to that. Look, they will be needing to raise capital, but it's going to take a long time. So I think it's time to start to pull back to index weight on banks, and maybe over time a little less. But there's no hurry. And
you're saying overall financial or just banks?
Overall financial and banks as well.
So that's 40%.
Yeah, and maybe pull back a little bit more. That's what I'm starting to do, but. It's. I think you've got time on your side, and while interest rates stay low, there's no pressure on banks. If interest rates start to go up, it's a whole different ball game for banks.
But Paul, they benefit in the short term when interest rates rise.
They will. Yeah. That's right. They do benefit because of the margin increases. But it's more of a question. This is about a yield compression market. As interest rates are so low, where else do you invest? You can get 5.5%, 6% yield in some of the bank companies, and it's still reasonable. It's almost a bit like an annuity. That's why the investors aren't going to sell them. And as long as they can keep increasing their bottom line, people will stay okay with them. So I think the ball changes when interest rates change. Lend Lease and New Farm, Peter, any views on those?
No, I don't. There's not companies that I've liked in the past. New Farm has done really well, but for a long time it was letting the team down. And Lend Lease, it's not one of my companies. What about you, Paul?
Look, I had a look at Lend Lease yesterday. I couldn't get excited about it.
Every time I've tried it, I can't get excited about it. And so New Farm's been a letdown merchant, but has come good. But I don't invest in those sort of companies.
Okay, I think we've done that question from memory. I always want to go, but a couple more questions to deal with before we just come to the end here. Bron, this is a very complicated question. I'm not sure people at home will have time to digest, but hence I'm sorry I didn't deal with it earlier. And essentially what you're saying, you've done really well out of Australian bonds and some corporate bonds. People who've been investing in bonds because of the fall in interest rates, the capital prices of bonds have increased. And then I think you're questioning about whether you should switch to the US market. I've been a bear on the bond market for the last 2 years and been wrong. That is, I've been one of these people saying I can't understand why bond rates are so low, and I've been dead wrong. So look, my question is, although I think the US dollar could fall a bit lower, we had 10-year bonds in the US yesterday down at 1.9%. I think they bounced back up a little bit. We had the 30-year get down to about 2.3%. Geez, I find it hard to get excited about that. So I reckon, look, our bond market will follow the US bond market to a certain extent. And so we saw the rally here. So I think if you're doing all right at the Australian market, I'm not really sure I'd be going into the US market. Would a higher allocation to equities make sense depending on your risk profile? Our answer would probably yes, because we think you're more likely to get 10% that in this market this year than you will in the bond market. I'd be wary at some stage about interest rates going up, so that's why I'd probably say that's what I'd be doing. But I'm not saying I'd necessarily be switching through the US.
And by the way, Paul, I've got Kumar Palga, who's probably one of the best bond players in this country. In the first week after Australia Day, I'll ask those questions of Kumar as well. Okay,
the last question, we've got a question from Wing about... I had a question about the cricket, but I don't understand that, so I haven't caught up what's gone on there.
It's 7 for 426.
7 for 426, so maybe that was a wind-up. A question from Wing about BHP, and be interested in your thoughts on that one. Peter, is BHP a buy at current prices?
No.
Are you nibbling on BHP?
Yeah, look, if for example, if you bought BHP at 35 and it's down, what, $28 something today, is it?
It's gone up a little bit. It's 29. It's up 65 cents today.
Yeah, I think it's a dollar cost average opportunity. But as you made the point, Paul, I think materials will do better in 2015, but there's no guarantee they're going to really bounce back big time. But over the next 2 or 3 years, I'd be happy to hold BHP. I know I'm quite happy with the dollar cost average price that I hold BHP at, and I'd love it to go back to 38, 39. But I think over the next 2 or 3 years it will do that, but not in the short term.
Look, I'm with you on that, Peter. I've been a little wrong on BHP. I've been sort of long BHP now for a long time. I don't feel inclined to sell it.
Well, it's a good company.
It's a good company. I prefer it to Rio, but Rio's done better the last few months. Not the first part of last year, simply because there's all this takeover speculation with Glencore. So,
and iron ore prices have fallen 47%.
Iron ore prices have. I prefer the diversified exposure of BHP across the 5 major classes as opposed to Rio's, which is 90% iron ore. So,
and a very simple story that when the global economy actually gets stronger, which we hope this quantitative easing right around the world will do, commodity prices will go up again. Not as high as where they were during the China boom, but they will go up again.
I think BHP and Rio, to a certain extent, have the future in their own hands. I think they need to cut production and get the price up as controversial rather than keep on boosting production. So I'll be writing about that later. So look, that's where we are in BHP. Again, I don't see any rush. And sometimes, you just got to recognise you run a portfolio, some stocks don't perform as well, but it's not a throw-out company. It's a great company, has great assets. It's not in the...
Well, I've many times I've hated Westfield, but this year it's done well, up about 25%. So sometimes you just have to stick with companies that you think are reasonable companies.
Right, I think we got through pretty well every question. I know it is just on 1:30 in Sydney time, and we're very conscious that we keep these to an hour, so we know many of you have got other things to go to, and thank you very much for joining us. So look, thanks for joining us this afternoon. We'll be back on the first Friday in February. If you want to put that in your diary now, it's on the 6th of February, I believe, and just on sort of 1:30 in Sydney. Thank you very much for joining us. Thanks, Peter, for your insightful comments.
Great pleasure. And we should actually make a point. This is the first broadcast we've made from our new offices in the CBD of Sydney. We've moved from Woollahra and we're now in the CBD.
Yeah, for those of you who are outside Sydney, we've moved from the very leafy suburb of Woollahra into the smoke of Sydney.
Yeah, from the shadows of the SCG into the smoky areas of CBD.
And this is our first broadcast. So thank you very much for joining us. And as always, we wish you the best investing. Peter will be back tomorrow with our Switzer Saturday Super Report. And we'll talk to you soon. So from Sydney, thank you very much and good afternoon.
Good afternoon.